All right, good afternoon, everyone, from the east side of the United States. And today I'm going to talk about a very niche topic, but also very interesting topic in the Copula's trading strategy. So today we're going to dive deep into the mispricing index trading. All right, so this is served as the part 2 of the Copula strategy talk. And last time I gave a talk at the Caston Business School. And this one is considered to be the second part. And okay, so let's get into what we're going to talk about. So the first one is we're going to do a quick review about the Copula method on what Copula is, because Copula methods, they are, the strategy itself is really straightforward. The hard thing is to understand what's the math part of it. The math concepts is the complicated part, and the strategy itself is relatively straightforward, and therefore it has a relatively high startup cost. But once you get accustomed to it, it's really not that bad. And then we're going to dive deeper into the MPI strategy to see its pros and cons, and to see some of the parts that we can change. And the third one, we're going to talk about a few variations and improvements that we can make to address some of the disadvantages of the original MPI strategy. And then later and then at last, we're gonna see are there any other ideas that we can put into use from other methods that may specifically not directly applied to Copulas before, and what kind of future works that we can expect to have. All right, so a few things about me. I'm currently a PhD candidate in applied mathematics at the University of Delaware. So my specialty is in stochastic modeling using PDEs, but I also do SDEs, and also do a few Copula modelings for the statistical arbitrage. That's honestly speaking why I'm here. I am currently also a researcher at Hudson Times. You can find me on LinkedIn and on Twitter. Just search my name. Usually the one that has the most followers, that's the one that I am. Okay. Okay, so first, let's talk about the Copula concepts. It's a quick review. Right, this is not all the math part about the copulas. There are a few books on what copula is and all the analysis you can download this. This is just the bare minimum to get we started in using the mispricing index. Right, so at first, how do we construct a copula? So at first, you find 2 random variables and you get data from them. Right, so for example, they can be temperatures, they can be today's stock prices, they can be the returns from stocks. They can be some index value, right? And then you map them to their quantiles, U1 and U2. So U1 and U2, they should be between 0 and 1 because it's quantiles using the marginal cumulative density function. And then you formulate this joint cumulative density, all right? And then you denote those as the capital C for Copula, U1 and U2. And if you plot it, it's going to be the first plot right here. Right, and you can see the value is in between 0 and 1, and when everything is 1, so C11 should be 1 because that's just cumulative density, right? And C00 is 0, and along the edges is also 0, right? So this plot is very straightforward, and it's not very interesting. So what's more interesting is the Copula's density plot. So if you take a partial differentiation of the capital C against the U1 and then against the U2, you're gonna see this. You're gonna see this graph. And usually, when people say sampling from Copula, they mean sampling from the Copula's density, not directly sampling from the Copula's definition. All right. So for trading, the key concept is called the conditional probability. All right. People call it conditional probability, but if you look at the definition, it should be conditional cumulative density. Right, but since people are using conditional probability all the time, I'm just going to say conditional probability just for consensus and consistency. And how do you calculate the conditional probability? It's also pretty straightforward. Just take a partial differentiation against the condition. So for example, here, if you are conditioning on U2, then you take differentiation of the definition against the U2. Okay, so how is this used? So let's look at here. So when the conditional probability is smaller than 0.5, that means that this variable is considered to be undervalued. So what does that mean? So in general, if you have a distribution that looks like this, and all the bars, if you add all the area up, you should have 1, right? 1 in total. And if the area that you add up cumulatively from the left side, it's smaller than 0.5, you can see this value is considered to be a small value. Consider all the values given, right? So therefore, if the conditional probability is smaller than 0.5, then this variable is considered to be undervalued. And very similarly, if the value is greater than 0.5, if the conditional probability is greater than 0.5, then this variable is considered to be overvalued, right? So this area adding up is totally greater than 0.5, and you can see this is a relatively large value, right? So this variable can be price, can be returns. It depends on what kind of value that you want to throw in, what type of value that you want to throw in. And another very important thing here is that this value, when you calculate it, it's copula dependent. So because this one calculates from a copula, it depends on what kind of copula that you want to throw in, and you're going to get different results. Okay, so now let's dive into the trading part. At first, let's talk about some of the nuances of the mispricing index strategy. All right, so what's MPI? What's the mispricing index? It's actually just conditional probability of the returns data, not the prices, just the returns. And as we have said before, when you are calculating the conditional probabilities, the probability itself, the formula itself is copula dependent. So it depends on what kind of copula that you use to model, you're going to have different results, right? And then once you have the mispricing index, right, so those are conditional probabilities, the results is going to be between 0 and 1. And you minus their average so that it will be between negative 0.5 to positive 0.5, and then you cumulatively add them up. So why do you cumulatively add them up? Because we're going to use this for trading, right? And when you're trading stocks, you're trading based on their prices. You're not trading based on their returns. So therefore, you need to cumulatively add up the daily misprices and mispricing index to mimic the returns, and then make trading positions based on the flag series or the cumulative MPIs. And here, why do you minus the average? That's because it's much easier to think when something is greater than 0 or smaller than 0. So here it's very easy to see that when the flag series or the cumulative MPIs is greater than 0, then that's considered to be overvalued. And if it's smaller than 0, then that's considered to be undervalued. It's just much easier to think once you minus the average. And again, because if we just directly plot the flag series or the cumulative MPIs and also the normalized prices, we can see that they look very similar. And there is a reason. That's because the cumulative returns or the normalized prices, they are constructed using the daily returns, right? So you cumulatively adding up the logarithm of the daily returns up, and then you're going to have the log prices, and then you take exponential, you're going to have the normalized prices. So very similarly, if you do the flag series, you're just adding up every day's mispricing, how mispriced it is every day. You add it up, you're going to have the series that looks like this. And another very important thing here is that those two series, they are highly model dependent. Again, because the conditional probabilities is calculated from a certain copula. It depends on what kind of copula that you have over here. The results are going to be slightly different. Okay. So why do we want to use the MPI strategy? Why do we want to use the mispricing index? The first thing is if we just directly use the cumulative, if we just directly use the conditional probability on the prices, that can't work. There is actually strategies based on that, but fundamental thing of concern is that the prices, they are not necessarily stationary, right? Because Copula worked on the quantiles, and if your stocks have an upward drift, the price is going to keep going up and up on average, and then it's going to constantly shoot through the roof of your training data based on the prices, and you're constantly going to have quantiles of 1, and that will break the model. So that's not a very good thing to do. And the second thing is some of the time series, they're really hard to fit. and it has term structures as well. So for example, this is a bad example, right? So here I'm just plotting the Apple's prices and Boeing's prices for the past 10 years. And here's what you're going to see, right? Because yesterday's price is going to be very similar to today's price on average, right? There is usually not a crazy amount of moves from day to day. And you can see that the prices, they may like bounce around like very close to each other. And so therefore you will have local aggregations. And there's no guarantee that y should be symmetric, right, on the both sides. So this is just a quantile plot. And so therefore you'll have a symmetry as well. If you want to use a certain copula to fit the shape, generally that doesn't work because the copulas people use in general, they are directly used by the mathematicians who constructed this copula for theoretical analysis. And so therefore the form of the copulas, they're very straightforward. Well, you can, technically speaking, by combining different copulas and have some mixtures, but then you're going to be subject to overfit. So therefore, if you do directly use the prices, you're going to have some of the issues that fundamentally cannot be directly solved by the copula modeling themselves. However, if you look at the returns, right, then this looks much better. It looks symmetric. There's not many local aggregations, and also the returns data, they are much more independent with each other from day to day as compared to the prices. Well, they're still not completely independent, but the assumption that copula uses, this is much by using the returns is much closer to the independent assumption. All right, so now let's look at the original approach. Okay, so what's the original approach? The original approach is proposed by Shen and also other authors from this paper, right? So their open rule is that their opening rule is that when it's overpriced, then you short. When it's underpriced, then you long. And so there are a lot of words over here, and I'm just going to guide you through some of them very briefly so that you understand what's going on, and other things follow very straightforward. Right. So when flag x reaches 0.6, that means x is overvalued, so therefore you short x and buy y. And everything is under dollar neutral as well, so you short and buy for the same dollar amount. And exit rule is also pretty straightforward. So if the trades are open based on one of the stocks, then you close the trade if the flag, they return to 0. So that means it's no longer overvalued or undervalued, or when it reaches plus or minus 2. So I'm pretty sure that the previous part is relatively straightforward, but why do you need to add a plus or minus 2? That's because the flag series themselves, or the cumulative MPIs, they are not necessarily mean reverting. And this is one of the fundamental weaknesses of this original approach. And so here, this is a sanity check. So it says, okay, if it drifted too far away from 0, then we just cut it off. We just exit the position. We don't do this anymore. Okay, so that means at this condition, we exit the current position. And also, they will reset the flag to 0 when they exit. So they also update the evaluation as well. Well, you can toggle this on and off. You can change all the numbers. You can change some of the logics in our module, right? And we're going to talk about it very soon. But for now, let's talk about some of the issues from the original approach, right? So the original MPI's approach, one thing is that the flag series themselves, they're not necessarily mean reverting, right? So you might look at this, you will say, hey, this is totally mean reverting. What do you mean by saying it's not mean reverting to 0? Right, so the thing here is the original method, they have a reset mechanism. So they will reset flag to 0 when they exit. And one of the exiting conditions is when they drifted too far away from 0. So therefore, this one this one is not a, this one has, let's see, how should I phrase it? Okay, so the flag series, it's somewhat illusional, right? So for example, here, it's gonna blow through the roof of 2.0 and it's gonna bounce right back to 0. It doesn't mean it's mean reverting, it just means that we arbitrarily set it to 0 again. So the logic is slightly different. And the second thing is sometimes it's extremely sensitive to changes. So for example, here in the 2009 April data, and you can see there are probably around 20 trading days, and you have around 8 position changes in just around 20 days. And those are using just the end of the day data. So you have 20 observations and you made 8 changes. That's just a bad model, right? In general, this is considered to be way too sensitive. And if a strategy does that, it better has a very good reason. And so here, this is the performance of this strategy. And this is the normalized prices. This is the equity curve, right? As you can see that in the end, it still makes a little bit money, but it has significant downturns. And also the two, so this is from a student T. So the red line is from the student T copula, and the green line is from the N14 copula. And you can see that their difference is, well, they basically follow the same shape, but they actually have some differences. That's because this method is very heavily model dependent, even though the fit score of the student T and N14 in this model, in this very specific example, they're very similar, but you're going to have somewhat different results. And this is one of the weaknesses of the strategy, and you should do something to improve it. Okay, so now let's talk about some of the strategy variations. And if we look back at the logic of the original approach, we can see that the opening rules is actually an OR logic. What do I mean? Is that if you look at 1 and 4, those are the cases when you short X and buy Y. That means you short the spread, right? So when any of those two is considered valid, then we short the spread. So it's considered to be an OR logic. Similarly, if we want to long the spread, right? And exit rule is also very straightforward. And if any of those two are satisfied, then it's an OR logic. And the third part is whether you can choose to reset the flags to 0 when you exit, right? So let's talk about some of the moving parts and what places can you change. The Copula model generates relative mispricing signals on each stock. So the mispricing signals, they're given based on each stock. And you're going to have signals from the BKD here, and you're going to have signals from the ESC. So our job is to assemble the two signals from the two legs of the trade, and see what see overall should we long or should we short. Right. So what are some of the issues to address? The first thing first is it's way too sensitive originally, so we want to bring down the sensitivity and make it only open and close at the time when we want it to open and close, or when it actually makes sense, right? And also the timing, and also the time, which is very heavily tied to the sensitivity. And the second one is it has arbitrary parameters. So it says it opens when the cumulative mispricing index is above 0.6. Where's the number come from, right? And it's very hard to interpret it to another audience as well. Like, why can't it be 0.8? Why can't it be 1? Why can't it be 0.4? And if you look through the literature, you can see that those numbers, there are a lot of varieties coming in those numbers, and everyone claims that their number is the right number. So there's definitely some arguments right here that what's the right number here? What's the right parameter? The third part is the strategy intrinsically is betting on the flag series or the CMPIs to be mean reverting. However, they are not necessarily mean reverting, right? And under very minor assumptions, you can sort of show that the CMPIs, they are martingales, but martingales are not necessarily mean reverting, right? And the fourth one is they are heavily model dependent. So there should be something that can be done over here to at least partially alleviate some of the weaknesses. And what can you do? The first one is you change the AND and OR logic in the opening and closing positions from the each leg. So it's basically trying to find the right logic to assemble the signals from each leg. And the second one is what's the best threshold, right? So there should be serious sensitivity analysis going on right here, and to check to at least find some of the better numbers for the signaling thresholds to make a trade. And the third one is probably there are ways that we can use the CMPIs to make it more mean reverting in a different sense. For example, by using a moving average instead of fixing it to be crossing the zero. Okay, so now let's talk about a more stable variation. This one is proposed by Rat's group in 2006, and the link for this paper is at the end of the presentation. So this one is also available in our MPI module by tweaking a few logics. So if you use an AND logic for the open and OR logic for the exit, then you're gonna get this result. Then you're gonna get this very specific variation. And you can change the open rules to be OR. You can change the exit to be AND. There are 4 different possibilities, AND OR 2 here, AND OR 2 here. But this very specific opening using AND and exit using OR is this variation. All right, so now let's look at it. So in assembling the signals from 2 different legs, they use an AND logic. Okay, so this should bring down the sensitivity a little bit, right? Because previously was an OR, here's an AND. Both needs to be satisfied to be able to justify an opening position. And exit is still the same. So when either flag series crosses with 0, then you exit, but then they make the stop loss position to be effectively infinity so that it doesn't have an upper bound to hit. And reset rule is they don't reset. Okay, so all of those parts, you can change them to whatever your own liking in the ArbitrageLab module. Here, we're just talking about this very specific variation. Okay, so now let's look at the result. So this is originally how it looks like. And after we're using the Rat et al., you can see that the position changes is much less frequent. And that means we bring down the sensitivity by quite a lot. And probably, if you look at the positions, probably the position is not changing as much as we wanted as well. So this one also has a few weaknesses, and we're going to address them. So what are some of the advantages from this variation? All right, so a key advantage is this one is much more stable than the original strategy. All right, and this one is also used more often than the original strategy. So if you see citations and what kind of people are actually doing researches on the Copula strategy, this variation has higher citation than the original one, and most people just base their methods based on their variations. And the third one is this one has a very stable performance in bear markets. So if the market is suffering from a downturn, when compared to the distance and co-integration methods, this method has very good risk control. And the fourth one is it has similar returns to the distance and the co-integration methods if the pairs converge. So if the pairs they don't converge, then they will suffer from the performance, and overall they have less returns than the distance and the co-integration. But if you're lucky enough to find the good pairs when they do converge, their returns are very similar. And overall, they are much more stable than the distance and co-integration in bear markets when the market has a downturn. And there are issues as well. A key issue is they're still betting on the mean reversion character of the CMPIs. While we have talked about it multiple times, it's not necessarily that they are mean reverting, right? Especially from the initial pair selection. Right now, people generally just use very simple pair selections for the Copula method, and there should definitely be more work done here in this regard. People generally just directly use, for example, Spearman's row, Kendall's tau, and also, what's the other one? Euclidean distance on normalized prices. So those are very primitive selective standards, and it has nothing to do with the Copula's nuances, right? So there should be some work done right here to choose the pairs such that they will converge. And then we'll have similar returns to the distance and co-integration, those classical methods, and they're generally much more stable in the bear markets as well. So you can have advantages from both sides. And still, again, it has those arbitrary thresholds. Well, this paper, if you read it through, they did some sensitivity analysis on the thresholds that they chose. So that's very good, but still that's 2 extra parameters, arbitrary parameters you need to fit. So there should be some other ways to alleviate this problem. All right, so that brings us to another variation, which is the Bollinger Band variation. Right, so what this does is you still calculate the cumulative MPIs again, right? But then your positions opening and closing is based on a Bollinger Band. So for people who are not familiar with this topic, a Bollinger Band is you calculate a moving window average, for example, the past 20 days of some time series. So here we're calculating the CMPIs, and then we have an upper bound and lower bound by some measure. So here we're the upper bound and lower bound, they are just the average plus the standard deviation multiplied by a constant. Usually you use 2 standard deviations. You can use 1. You can use 3 standard deviations. Usually people use 2, right? So when it's considered overpriced when the CMPIs is above the upper bound of the Bollinger Band, and it's considered to be underpriced when it's lower than the Bollinger Band. Then when it's lower than the lower bound of the Bollinger Band, then you will have the signals from this specific stock, right? And then you need to assemble the two signals together from the 2 different stocks. How do you do it? So here's just one example. You can choose all sorts of examples. So for example, if X says that is overpriced, or when Y is underpriced, you can make it short. You can change this to be an AND as well. It depends on your own liking. Similarly for the long part, right? The exit rule is also pretty straightforward. So you can change this either to an AND. So if either flag series crosses with the mean, then you exit. Or when both flag series crosses with the mean, you can exit. So there are a lot of moving parts that you can play with right here. And it's very easy to code it as well. We do not directly provide the Bollinger Band variation for this specific cumulative mispricing index module, but we do provide this for the Vine Copula module, right? And if you want to code it by yourself, it's also pretty straightforward, just using the rolling function of the pandas data frame, and it's very straightforward to code it. Okay, so what are some of the advantages? One key advantage is that it's mean reverting for the CMPI to cross with the moving average, and also it's self-adaptive as well. So because it looks back for the past 20 days, it has a moving average. So you don't need to keep on track of whether it crosses with 2 or whether the CMPI crosses with 0 or not. So it's much easier to use. The third one is very surprisingly, or very unsurprisingly, it captures the overpricing and underpricing opportunities really, really well. That's generally when you are expecting the mispricings to happen. If you just directly look at the prices themselves. And the fourth one is very few people, they use the Bollinger Band method with the Copula method. As far as I know, I haven't seen a lot of literatures using pairs trading with Bollinger Band coupled with Copula methods. One key issue for this is it exits often too early, and sometimes just hope that it can hold a position for a couple of few days. Instead when they crosses, when the CMPI crosses with the Bollinger Band average, then they just exit. So it exits often too early. And if you want to improve this strategy, this is a key direction to go to. Okay, so there are some other ideas that's worth trying. So all of those ideas come from literature as well, well-regarded literatures, and they were not previously used with the copulas before, but at least not under our current context, but it's worth a try. Right, so the first one is instead of just trading one pair of stocks, you form a stock cohort and then trade against an index. Right, so why do you want to do this? The first one is you want to diversify your portfolios. You don't want to put everything in just one pair of stocks, right? And when you diversify, the downturn is going to be averaged a little bit. So you will suffer much less from the idiosyncratic features from the stock pairs that you chose. And also when you're trading against an index, it's much cheaper instead of long and short individual stocks, right? And the second one is you mix the price and the returns method for the signal. So we didn't talk specifically about the price variation method for the Copula strategy. but I talked about it in the part 1 of the video. And here, if I need to review real quickly, so basically the price variation is very, very stable and resilient to the changes, probably a little bit too rigid, whereas the returns method that we have talked about all the time throughout this presentation is much prone to the changes. So if you mix the signals and give them different weights, and they should somehow cancel with each other and will give you reasonable returns. So this again is another way of thinking how to diversify. So you don't just look from, you don't look at the strategy just from one single method. You look at them from different suggestions and then try to assemble the signal together. The third one is you can copulating with alternative data. There's nothing preventing someone copulating like stock price or futures price with temperature, with macroeconomic indices, right? And not many people has done this, as far as I know, in the literature world. So there might be some structures that's left to be exploited by the traders. So you can definitely go into that direction. And especially in higher dimensional Copula modelings, I will talk about this very soon. You can add in some of the factors as you can add alternative data as some of the factors. It doesn't have to be the prices of some financial products as well. And also Copula was used by risk analysis people, by risk analysts all the time. And people use Copulas for pricing. They consider all sorts of factors, not just the prices of certain financial products, right? So this is definitely a direction that's worth going into. Okay, so a few interesting problems. So those are key problems that's left to be unsolved. That's left to be solved, and if you can solve any one of these, you're guaranteed to have an edge in the market. So the first one is dedicated pair selection criterions. So if someone can develop a much better suited pair selection criterion for the copulas, then their model can have very good performances. The second one is optimal exit time for the Copula methods. As far as I know, there's no research done right here. So if someone is able to pull this off, then extra profit here. Third one is term structures. Copula is originally used to model independent draws from random variables, whereas financial world, even the returns, they will have term structures, not to say prices, right? So different years, they look very different. So if there are some ways to curate to the need, then this will be great. And the fourth one is stats tools for selecting copulas. All right, so right now the fitting copula score is still pretty primitive. Generally, people use the AICs and BICs information criterions, and also use maximum likelihood. If someone can find a better tool to do this, then that would be great, so that it can select the better candidates, better copulas for the result. Right? Okay. Any questions?